Hello, everyone. This is Mary Moore, the Executive Director of the Retirement Industry Trust Association. Welcome to our webinar today. We're happy to have John Heyer, a tax attorney, with us to talk about unrelated business income tax, as well as 990T filings. So with that, John, take it away.
All right, just a brief introduction. My name's John Heyer. I am an attorney, accountant, and also investor. I use my self-directed IRA and 401k accounts just like a lot of my clients, and we do an awful lot of work both in the planning space for self-directed IRAs as well as fighting in tax courts, thus far successfully, and we also do tax returns, for example, the 990Ts. So anybody who's interested in follow-up or more information, you've got our address there. And yes, we are now in Puerto Rico. There's a massive tax break for being here, and add to it that even if they took the break away, I don't think I would leave. We're awfully pleased with life in Puerto Rico. In fact, I'm just looking out now at the bay where the cruise ships are, although I think they're a little empty right now. So let's get into the UBIT and the 990Ts. To give you an idea of the order, I'm going to cover UBIT first. So describe UBIT, some of the concepts, and some planning ideas, because then the 990Ts make more sense, since those are the tax returns you file to record the UBIT. So first UBIT, a little bit of planning, then we'll get into some 990T specifics, and last but not least, cover some questions. We do have different roles. I want you to understand my bias. We all have a bias. I am not a custodian, and so the way I look at tax planning and tax advice is different than a custodian will look at it. So I gave a slide for that. My job is twofold. One, it's to keep my client out of trouble. Two, it's to save them as much as possible. And to that end, I'm extremely proactive. I give actual legal advice. So the thing that you all say to people on the phone, the custodians say to people on the phone, we're not giving legal advice, I am. Your job is usually just to make sure that if the client doesn't do something blatantly and obviously stupid. And so sometimes they need to be made to understand that you're not their advisor. The fact that you might put a halt to a transaction is not because you're the advisor, it's because you recognize what they're doing is so wrong that it could impact them and yourself. So we have very different roles. I just wanted to remind you of that because my perspective of when I'm giving advice or when I'm looking at the code, it's going to be a little bit different than yours. So what is UBIT? It's a tax on certain transactions. The way I describe it to clients is your IRA is tax-free except for when it's not. And that usually gets what do you mean? Not tax-free. It's always tax-free. No, there are always exceptions. That's what Congress does. So we have this tax called UBIT. It applies to IRAs, 401ks, HSAs, cover deals, and the other retirement plan types, including simples, SEPs, qualified plans. So it applies fairly much across the board, and the rules are almost identical based on the account type. It is a high tax. After the first $12,500 of income, it's at a 37% federal rate. That's the top rate for the feds. And then you can tack on the state rate, which in a place like California, that's going to get you up right around 50%. So it's a pretty serious tax, and it's well worth understanding and, when possible, avoiding or mitigating. It is paid by the account and not by the account owner. If the account owner were to pay it, that would be treated as an excess contribution and give rise to its own set of issues. And I do want to point out, people often miss this, the tax is only 20% at the federal level on capital gains transactions. So basically, if the IRA, and I'm just going to use the term IRA generically to mean all of those accounts because it's really awkward to keep saying your IRA, 401k, HSA, yada, yada, yada. So when I say IRA, by and large, I mean all of the other accounts. When the IRA enters into a transaction that under regular tax law would have been treated as a capital gains transaction, the UBIT rate on that transaction drops from 37% down to 20%. So it drops almost by half. That's a significant point. And we've seen a large number of tax return preparers miss that. So that's what UBIT is. What triggers UBIT? It's basically three things, and it's pretty straightforward. There's some nuance to each of the three things, and I'm going to cover that. But the three things that cause UBIT, the renting out of personal property. And by personal, I mean personal as distinct from real property. Some people hear that and they think their own property as opposed to the business property. And here, no, we're talking about the difference between real versus personal property. So if you rent out automobiles like Hertz Rental, Rent-A-Center Furniture, Meth Labs, those are all examples of personal property. Renting that out would be taxed at UBIT rates. The second thing one can do to give rise to UBIT in their account is to borrow. If the account borrows, then UBIT is paid proportionally to the borrowing. And I think that's easiest to illustrate through example. For example, my IRA buys a rental property, puts $10,000 down, and borrows $90,000. 90% leverage, right? You do the math, it's 90% leverage. Therefore, 90% of the resulting income will be subject to UBIT, whether it's rental income or profits on sales. You calculate this income almost exactly the same way you would on a regular tax return. Almost all the tax rules apply. So whatever deduction you can get, whatever tax break you can get on a regular tax return, you also get for UBIT purposes with one big exception, and that's going to be depreciation. For UBIT purposes, you have to depreciate straight line, AKA you have to depreciate the old-fashioned slow way. Some of this accelerated depreciation where you can write off assets much more quickly doesn't really apply for UBIT purposes. So that is the one adjustment that we typically have to make. You calculate UBIT taxable income the same way you calculate normal income. All the breaks apply except for depreciation. So borrowing is another way to create UBIT. And I simplified this example because actually the way we calculate this for filing the 990T is on a monthly rolling average basis. We compare the adjusted basis, which includes depreciation, to the present principal balance on the loan. We take a snapshot each month, and then we average that over 12 months. Whatever number that gives you, whether it's 90% or 89.2% or whatever percent comes out of that averaging process, the net income is taxable, multiplied by that rate, multiplied by the UBIT rate. So borrowing is only taxable to the extent of the leverage. And we're going to talk about some ways around that. There's a big exception, by the way, and I don't have it on the PowerPoint. When a 401k borrows to acquire or improve real estate, when a 401k or other qualified plan borrows to acquire or improve real estate, it does not pay UBIT on that transaction. And people ask me, well, why is that? That doesn't make any sense that 401k gets that break and an IRA doesn't. Why is that? Well, just because Congress said so, and sometimes they say things that don't make sense. I want to caution you, a lot of our mutual clients think that 401ks are completely exempt from UBIT. We get that a lot. No, 401ks are only exempt from UBIT when they borrow to acquire or improve real estate. So if a 401k rents out personal property, it pays UBIT just like an IRA. If a 401k borrows on real estate, but uses that money for something else, it does not use the money to acquire or improve real estate. It borrows maybe on a free and clear rental it's got, and then runs off and uses the money for something else. That would not be exempt from UBIT either, because the proceeds have to be used to acquire or improve real estate. So it's an exemption I did not have on the slide to the borrowing UBIT. The last of the three categories is probably the most subjective. So the third thing that can give rise to UBIT is engaging in an unrelated, and here's really the key term in quotes, an unrelated business that is carried on continuously. So a continuous trader business, and that's subjective. There's a lot of law on what is a trader business. There's not very much law on what is a continuous trader business. How much business does the IRA have to do for it to be continuous? There's a lot of subjectivity. There's not a lot of case law to guide us, and we're going to get into that. Speaking of continuous trader business, I decided since it was gray, I would make it the next slide. what is a continuous trader business? I think really two categories are no-brainers that you've got a continuous trader business. Either the IRA owns an interest in a business that provides services. So maybe the IRA, we've seen them own everything. We've seen them own title companies, parts of law firms, parts of real estate brokerages, you name it. All of that would generate UBIT. Why? It's a business that provides services on an ongoing basis. That's clearly going to be subject to UBIT. The other example where it's a no-brainer is if the business sells inventory, and that is what it does. So I always like the example of a Dairy Queen or pretty much any sort of retail establishment. It could be physical, it could be online. Somebody could be selling things, for example, through their IRA on eBay, and then going and buying more things through their IRA and turning around and selling it on eBay. Even though it's virtual, it's still a retail establishment. It still has inventory. It still sells things over and over. Now, lending is, I think, never a continuous trader business. Or let me clarify. Let's use better language. I think lending can be a continuous trader business. In other words, if an IRA lends enough with enough frequency, could it be a continuous trader business? Sure, but it's not subject to UBIT. Why? Because the way the code is written, it exempts interest from UBIT, even if it's a trader business. It trumps the usual trader business issues. And for an example of that, I would direct people to take a look at Revenue Ruling 79-349. Here's a classic gray area. This is probably the most frequent time that we get into with clients a discussion of, do you have an ongoing trader business and we're not really sure? And that's when they buy and sell real estate. Now, let me be clear. By buy, I mean they actually take title. And I don't mean a double closing, right? A lot of investors will have a double closing where the IRA takes title to the property for about 30 seconds, 100% funded by someone else's money, and then immediately sells the property. As far as I'm concerned, under tax law, you never really took title when you have a double close. But if you'd actually take title, typically rehab or typically sit on it for a little bit, and then turn around and sell, how much of that do you have to do until you have an ongoing or continuous trader business in the IRA? There's not a lot of good law on that. I would say first, size matters, right? If you're doing a very large project, for example, a 60-unit apartment building, and you don't rent it out, your IRA buys it, renovates it, and sells it, or even worse, turns around and turns it into condos and sells it one unit at a time, I really think you've got 60 deals, not one deal. That's clearly going to be an ongoing trader business. But typically with the investors I see, a lot of the time they're buying single family houses, rehabbing and selling. How many can you get away with? We don't know for sure. My rule of thumb is you can probably do 2 a year for 2 out of 3 years. 2 a year for 2 out of 3 years. And the idea is you skip a year so you don't have what? A continuous trader business. Now that's great. Could we lose that argument? Sure, I think the odds are low that we would lose. But do I have any case law that says that's 100% safe? I do not, but I think it is. When you start seeing an increase in volume beyond that, I think we have a much larger chance of a court looking at this and saying, you know, you've got enough volume of buying and selling houses that as far as your IRA is concerned, those houses are inventory. You're starting to become Dairy Queen. So the larger the volume and the larger the deals, the more likely that we've got an ongoing trader business. I think it's very similar with development, right? IRAs that develop property, maybe they buy and rehab, or they buy and tear down, or they buy a piece of raw land, get it entitled, and then build on it. If they turn around and sell, I think that very quickly becomes an ongoing or continuous trader business. Why? Because it's a very high level of activity. And the court's going to look at the level of activity to decide, is this continuous? Now, I think an exception to that is when there's development, but then the IRA sits on the property and rents it out for, let's say, at least 18 months. I'm comfortable with 18 months. I really like 2 years. So the IRA buys a property, a land, let's say, builds on it, but then turns around and rents out the building for 18 or better yet 24 months. Is that going to be subject to you? But not unless you borrowed. But in terms of it being an ongoing trade or business, I don't think that that matches the definition. I do see clients in IRAs doing assignments where the IRA, by which they really mean them, that's part of my issue, they say the IRA went out and signed a contract on a property, paid $100 down, and then later sells that contract, maybe a $10,000 sale. Typically, they'll call it a wholesaling or a signing. Sometimes they use options to get to the same result. That is all subject to UBIT, and I think that has other issues that we've discussed in other webinars. I think there are other issues with assignments. Just to give you the end of the story without telling you the story, I think the courts are very likely to rule that when an IRA has very little money in a deal, they pick up a $100 contract or a $100 option, turn around and quote unquote sell that contract or option for, let's say, 10 grand. The courts are very likely to look at that and say, the IRA didn't really do anything, you did. I think that belongs on your 1040, and if you didn't report it, there are going to be penalties for not putting it on your 1040. And then it's going to be as if you made an excess contribution to your IRA, which generates further taxes and penalties. So I'm not a real fan, or at least I don't recommend, assignments and options in IRAs. To the extent people do those, I think it clearly gives rise to UBIT, and it is clearly a continuous trade or business. Here's the one that catches people. Here's the subtle one. So everything we've discussed so far is the IRA directly doing something that gives rise to UBIT. But when you invest in a venture, or I should say, when your IRA invests in a venture, whatever that venture does, if it's a pass-through entity, if it's an LLC, if it's a limited partnership, if it's a general partnership, which is pretty rare, we see those once in a while, but typically it's an LLC or a limited partnership, everything the LLC does, or everything the limited partnership does, the IRA did. So if the IRA invests in an LLC, even if it's a tiny percentage, let's say the LLC is $100 million and the IRA invests $10,000. If the underlying LLC borrows, it's as if the IRA borrowed. If the underlying LLC is engaged in a trade or business, it's as if the IRA directly engaged in that trade or business. And this is lost on a lot of investors. They either don't hear it or they don't want to hear it, and it comes as a very rude surprise down the road. So if they invest in something that lends, or invest in something that rents out personal property, or invest in something that itself has a continuous trade or business, that K1, whatever comes through on the K1, is subject to UBIT. So that's something we need to remind our investors of. This is a frequent problem for them. So that the thresholds are met, and we'll get into the thresholds of how much income has to come through on a K1 for the 990T to be due. We'll get right to that, but I really wanted to emphasize this point. A lot of people miss it. Some planning techniques, and then we'll get into the 990Ts. So that was the basic explanation of what is UBIT, how does your IRA quote unquote get UBIT? What are some planning techniques to mitigate it? In cases where you have a continuous trade or business, or very high leverage, which I would call 80% or more, the IRA would be better off oftentimes, and we'll get into some of the math, running the trade or business through a corporation than directly. So if an IRA has a continuing trade or business, let's say a Dairy Queen, it runs this Dairy Queen directly through the IRA, takes title to it, it owns it, or it gets it through a pass-through, it owns it through an LLC, then it would end up owing 37% tax on the net income. The IRA may be better off owning that interest in the Dairy Queen through a C corporation. So the IRA would cause a C corporation to be formed. It would pay some outside counsel to do it properly. And instead of 37% tax, it would pay the 21% corporate rate. People often ask, well, what about the double tax? Aren't corporations double taxed? Generally they are, but not if they're owned by an IRA. So the corporation, let's say you've got a Dairy Queen, it makes $100,000. It's held by a C corporation. You pay the 21% corporate rate, but not the 37% UBIT. That's a massive savings. That's 16 points, or about 42% savings. Then the corporation distributes a dividend to the IRA, but that dividend to the IRA is tax-free. So if you or I personally, individually owned the C corporation, we would pay tax on the dividend. There would be a double tax, but not for an IRA. And that's why this works. A few tips. The IRA, typically when we do this, there are exceptions, but typically the C corporation is 100% owned by the IRA. And we have to remind the taxpayer that the C corporation is a disqualified person when it comes to the IRA. There are things that the C corporation and the IRA are not allowed to do. For example, lease each other property, buy or sell property from each other, or make contributions of capital more than once. That would be a prohibited transaction. In other words, when the IRA forms the C corporation, it can fund it, but that's the only time it can fund it. It can no longer contribute money to it. It can no longer lend to it. So if that C corporation needs more money, it's going to have to find an outside source that is not a disqualified person in order to do that. Now, what's the downside of this approach? And this is where you have to do some math. If the trader business has a capital asset, such as a building that it operates out of, so I don't just own the Dairy Queen franchise that leases a building from somebody else. I own the Dairy Queen franchise plus the building. Now there's a downside to doing this through the C corporation. The upside is the income that comes out is taxed at the lower rate, 21%, not 37%. The downside is I could have sold the building inside my IRA tax-free, and now if I sell it, I have to pay the capital gains rate, or in this case, the 21% corporate rate. That's a downside, so you have to do the math. For example, if the income is very large and you're going to hold this for a long time, the savings from paying 21% over the years versus paying 37% probably outweigh the building being taxable when you finally sell it. On the other hand, if the building's extremely valuable and you're not going to hold the business for very long, then you might not want to use the C corporation. In other words, you might eat the 37% rate on the business, but preserve the ability to sell the building tax-free. Clients often say, well, why don't we just separate them? Why don't we put the building in an LLC? Why don't we put the Dairy Queen business in a C corporation? And the problem with that is the C corporation, it's a disqualified person as to the IRA. So if it has a business, it can't use the IRA's property, in this case, the building. That would be a prohibited transaction. So you kind of have to choose. It's all or nothing. You avoid, or I should say, you drop the UBIT rate, but the building, in this case, is taxable for capital gains purposes when it sells. Or you can sell the building tax-free, but now you're going to pay the UBIT rate instead of the corporate rate. So that's blockers. Shared appreciation mortgages. These are loans that are drafted such that the interest is not a flat rate, rather it's a percentage of the profit. So a normal loan might be an 8% loan. We might say the IRA is lending to someone and getting 8%, where with a shared appreciation mortgage, we draft the loan very carefully. There's a lot of tax law behind this, but basically we say, well, instead of an 8% flat rate, we get 50% of the profit on whatever it is we're lending on. This is extremely common with flippers. Right? We see an IRA joint venture with a flipper. So the IRA brings the money to the table. The money is used to buy and rehab a property. So the IRA is the funding partner. And then the other partner is usually the sweat equity person. They do all the work, they find the property, they oversee or perhaps even do the rehab, they do the sale, and then they split the money. And oftentimes it's split 50-50 is pretty common. The danger of a joint venture is that if this is viewed as an ongoing trader business by the IRS, and I think there's a high chance it would be, if this is viewed as an ongoing trader business by the IRS, then the IRA partner is going to pay UBIT, because remember, anything the partnership does, the IRA partner is deemed to have done, or anything the LLC or anything the limited partnership that the IRA invested in does is deemed to have been done by the IRA. So the downside of these flipping joint ventures is that the flipping itself may be viewed as an ongoing or continuous trade or business and create UBIT liability for the profits that the IRA makes. Now, our classic workaround in these deals is we restructure it as a loan. It has to be carefully done because you've got to structure the loan so that the tax court looks at the loan and says, that's a loan. Just because you put loan on the document doesn't mean that the IRS will accept that it is actually a loan. The IRS operates on substance over form. So they can look at a loan document and say, you know, that's really a partnership. And you're back at square one where you started. You don't want that. So the document has to be very carefully drafted. There are actually 14 tests that the tax court applies to determine if a loan is really a loan. And those are the 14 things that you want to make sure are in the document so that when the court sees the one funky thing, I mean, what's funky about a shared appreciation mortgage? Well, your interest rate is 50% of the profit. That's not normal, right? It's been done, it's out there, but it's not common, so it's going to raise eyebrows. So we want to make sure everything else is bolted down such that the IRS or the tax court will look at the loan and say, yeah, that's an odd loan, but we do agree that it's a loan and that you therefore don't owe UBIT. But the other thing we have to look at is local law, right? We have to make sure that the loan is enforceable and non-usurious under local law. So usually when I draft these, I will be dealing with local attorneys and we coordinate. I make sure it works for the IRS. They make sure that the loan document works for local law. So this is one way, instead of JVing on things that could give rise to UBIT, that we get around it by lending on things that would have given rise to UBIT. But now that we're a lender, no longer give rise to UBIT. And by the way, there's a bonus. From an asset protection standpoint, I think you're a lot safer as a lender than as a partner. There's less if something goes wrong or something goes bad. I think you're a lot better off being a lender rather than a partner. So it's sort of a bonus in these situations. This one, preferred dividend, and I abbreviated it, of course, PrefDiv, preferred dividend LLCs. It's a way for your IRA to get financing without actually borrowing. It's a way to get financing, and if you negotiate well, it's a way to get cheap financing without borrowing, and therefore without paying UBIT. So what do we do? Instead of borrowing, so let's agree that if my IRA borrows 90% of the money for the project, it's going to be 90% taxable on the project. One way to avoid that is to set up an LLC. The IRA is a common member, and the investor, the person bringing the money instead of a loan, is a preferred member. So they might get, for example, an 8% preferred return. They get 8% every year, could be paid in arrears, could be paid currently, that's negotiable. They get all their money back, and then whatever's left over, the IRA gets to keep. Well, what does that sound like? That sounds a lot like a loan, right? You pay the interest rate, you pay back the loan, whatever's left you keep. Here you pay the preferred dividend, you pay back the investor's capital, and whatever's left you get to keep. But with one huge difference. This is no longer, when we structure it as a preferred dividend LLC, we no longer have a loan, we no longer have debt financing, we now have equity financing, and fairly cheap at 8% equity financing. So no UBIT, right? The UBIT only occurs when the IRA borrows. If the IRA partners, even if the partnering mimics a loan, as long as it's not too much like a loan, in other words, now we go in the opposite direction. When we talked about shared appreciation mortgages, we want to make sure the mortgage is debt, not a partnership. Here, when we set up a preferred dividend LLC, we want to set up so that it's clearly a partnership, a joint venture, an LLC with an equity investment and not debt. So for example, sometimes the investor in the LLC will say, well, I want to lien on the property. And as a tax lawyer, I say, I don't like that, because now you're starting to make this arrangement look like a loan. When the investor comes back and says, well, all right, I would have lent money to you at 6%, or should I say loaned money to you at 6%. And because of the extra risk here, since I don't have a lien, I want 8%. Is that a good deal for everyone? Yeah. The investor's getting compensated for extra risk, but your IRA is avoiding UBIT. And the UBIT would have been a lot more expensive than an extra 2 points on the financing. Do the math. So this ends up being a great way to use leverage without paying UBIT. Very classic planning approach. Make sure the lawyer who drafts this understands prohibited transactions, understands UBIT, understands subchapter K, which is the partnership provision of the code, and understands the rules that distinguish a joint venture from debt. Those are all key concepts when you're drafting these kinds of agreements. All right, so now we've covered UBIT. We've covered some planning techniques. When is the 990T? That's the tax return where we report UBIT. Who has to file? Who does not have to file? When is it due? It's only due for an account that has $1,000 or more of gross income. Now that's a key concept, because you can have $1,000 of gross income, but negative net income. And so that's kind of confusing to me. You know, when I first thought about that, I thought, so if I have 1,000 in gross income, but let's say I have deductions of 1,500, so I have negative 500 net income, do I still have to file? And I think the answer is no. If you look at the 990T instructions, when there's negative income, even if the gross was over 1,000, you don't have to file. In fact, what the instructions say, because we get this a lot, this is actually when we tell people don't pay us, at least not right now. They'll call and say, I've got a K1 that's negative, or I have an investment that was a loss, and I want to file a 990T to protect that loss, meaning I want that loss to be available to offset income in future years. And I agree, that's a good goal. You want the loss to be available, typically as a net operating loss, in future years to offset gain, but you don't have to file a return to do that. If you look at the 990T instructions, they explicitly say that as long as you can show what the loss was, you did not have to file a 990T for negative amounts in prior years. So bottom line, when there's a negative amount passing through, you track it, and you want to be able to prove that that was the income, because down the road when there's a big gain, then you want to be able to use the loss to offset the gain. The classic example of that, rentals. When people invest in rental syndications that are highly leveraged, it's very common for the K1s to show a loss and during the operating years, right, with depreciation and interest payments and everything else. It's very common that there's a loss during the life of the project, but then at the end, when the property is sold, there's a huge gain. In those cases, the only year in which one has to file the 990T is that gain year, that final year. You don't have to file in the interim, you just track the losses. All 990Ts are filed on paper. The IRS presently does not have electronic filing for them. So it is dead tree. Please, 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 when people send these in, send them certified mail. Everything except for checks, and even sometimes those that you send to the IRS or to a state taxing authority, need to have certified mail if you're sending it on paper, because they will say they never got it. The due date is the same as your personal return, April 15th of the subsequent year. So for example, the 2019 UBIT return is due April 15th of 2020. You can extend via Form 8868, and that extension gets you until October 15th to file, Here are the penalties. So if you file late, it gets expensive quickly. The late filing fee is 5% of the tax owed per month. So if there's no tax, there's no late filing fee. Up to 25% of the tax owed, unless you're 60 days late, in which case then there is a fee even if you don't owe. If you're more than 60 days late on filing the 990T, then the minimum penalty is $435. So it's 5% of the tax owed per month, up to 25% of the tax owed, and if you're more than 60 days late, the minimum penalty is $435. There's an additional penalty for paying late. So you might file the return, but you can't pay until later, which, by the way, if you're in that situation, it's still better to file and not get the late filing fee and only have to deal with the late payment fee. So the late payment fee is 0.5% per month, 0.5%, 0.5% per month, up to 25% of the tax owed. And then the last penalty I wanted to put on here that's likely to apply, if the tax is understated. So when you fill out this 990T and you spit out a number, here's how much tax is owed. If you understate by at least $5,000 or 10% of the tax owed, whichever's greater. So it's 10% or 5,000, whichever's greater. Then you may owe this 20% penalty on the tax. For example, I owed $1,000 and I only reported 100. I understated by 900, which is way past 10%. So I'm going to owe 20% on the 1,000. It's a $200 penalty. This usually happens when people fail to report income or if they took an aggressive position. For example, I flipped 15 houses. I don't think it's UBIT, so I didn't report it. I greatly understated my income. I got audited. And in the audit, the IRS said, look, 15 houses flipped. You owe UBIT. That's probably not a great example because I don't really think that's very gray. Let's change it to 5. I flipped 5 houses one year, 5 houses the next year. I decided that 5 houses was not enough to have a continuous trader business. I get audited, and the IRS says, yeah, that's kind of gray, but we really think that that is a trader business. You would owe at this point the 20% tax because you understated your income. There is a defense. So when you do something that's gray, even if you lose, there are 2 ways to avoid this penalty. So let me repeat that. If you do something that's gray, in this case, you don't report UBIT because you were arguing that 5 transactions is not enough to have a continuous trader business. And that's arguable. I think that is gray. Then if you lost, you'd pay 20% of the tax save, but how do you defend yourself? There are 2 ways to avoid the penalty. One, you disclose it. There's a form that you disclose, hey, IRS, I'm taking a gray position. Now, a lot of people think intuitively when I disclose a gray position, I'm going to get audited. You know, the audit rates when we file those forms consistently, and I've Googled the heck out of this and talked to accountants who file thousands of returns. Consistently, the audit rate on the audit me form, because that's essentially what it is. You're reporting that you did something gray. You're saying, come audit me. The audit rate on that is only about 5%. I was kind of surprised when I learned that. So you either file the audit me form, the disclosure form, or when somebody looks at the gray position you took, even though you lost, in hindsight, somebody could say, you had a 40% chance of winning. A judge would agree that even though you lost, in hindsight, the position was gray enough that you had a 40% chance of winning. It just happens that you didn't. Meaning you had a pretty good argument, even though you lost, it was a pretty good argument. So if you have a pretty good argument, or UBIT return in gray cases. So for example, and the classic case again is we have a taxpayer who flips 3, 4, or 5 properties a year. No, that's not clearly UBIT taxable. It's not clearly a continuous trader business, but it could be. And so we tell the taxpayer, if you're going to take that position, that's kind of aggressive. If you're going to take that position, file the 990T. And the reason is we want to get the clock started on the statute of limitations. We want to get the clock started. The normal statute of limitations, normally in UBIT cases, the IRS has 6 years to audit. Sometimes only 3, but usually 6. And it has to do with the amount of dollars involved. Usually it's 6 years. If they never file the 990T, the IRS can audit them into infinity. So the whole point of filing the 0 return is to start the statute running. A question that we get is, if I file a 0 return, I mean, doesn't that look funny? Aren't we more likely to get audited? And while that makes intuitive sense, in practice, we're not seeing it. I have never in 25 years of practicing seen a 0 return result in an audit. In fact, I haven't even heard of that happening anecdotally, whether on the net or whether talking to fellow accountants and lawyers. So I don't think there's a lot of danger in filing a 0 return, and I do think that there is some upside to it. In fact, when it comes to, for example, filing Form 5500 for your 401k, A lot of 401ks are not required to file a 5500 until they have at least 250 grand in assets. We often advise file it anyway because it gets the statute of limitations going. As I mentioned before, there's no need to file a 990T in loss years. No need to file it in loss years. The only time that would make me nervous, let's say the gross income's really high and there was still a loss, that year I might file it. Why? Because technically we're still above and well above the $1,000 gross income threshold. So I might, if the gross income was very high, I might file the 990T just to get the statute running on that. Sometimes I get a little conservative when the numbers are larger. Now, this is the new law. This is the new law that came out about 2 years ago, back in 2018. Section 512A6 was added to the code. And what it said was, let's give you an idea of what the old law was. That'll make it easier to explain. The old law was that you netted all the trades or businesses. You netted all the activities that were on the UBIT form, on the 990T. So maybe your IRA invested in 5 things and 2 made a loss and 3 made a gain, and you netted it for a smaller gain. In other words, the loss from other activity that the IRA was involved in offset the gains, and that's good for the taxpayer. Well, Congress wanted to raise revenue, so what did they say? They added this and said, look, if your IRA invests in 5 different trades or businesses, if your IRA invests in 5 different trades or businesses, 2 make a loss and 3 make a gain, you're no longer allowed to offset. In other words, if the business that makes a loss never ends up making a gain, too bad, tough luck. We're not going to let you use that to lower other income. So what becomes key? Well, what the heck is a trade or business? The code says trade or business, each one is essentially a silo. So now defining what the heck is a trade or business becomes critical. And so far, it's been about 2 years since this law passed, and we haven't gotten any guidance. We haven't gotten any, I shouldn't say that. We got a tiny amount of guidance, but it's not a lot. I use the guidance. I mean, well, here's what they said. We're going to eventually come up with regulations. We're eventually going to tell you what is a trade or business. Eventually. We're going to do it at the speed of government. So in the interim, what we're going to allow you to do, they put this out in the notice, the IRS said in the interim, we're going to allow you to rely on the NAICS system. This is the one that defines every business in the country gets a number, and you fill out on your tax return, what business am I in? For example, rentals, I think, are 531, 130, or some number similar to that. This is great for the taxpayers, because what does this really mean? Let's say my IRA invests in 5 rental buildings in 3 different states. There's a question of, is each building its own trade or business, which would be a bad answer, because if one of the buildings makes a loss, then I can't offset it against the other buildings. And what this says here is, look, as long as everything is in that same code, which is in this case, residential rentals, commercial rentals, then it's the same trade or business. I like that. That's very broad. It means, in my mind, the way they've written it, until they tell me otherwise, what that means is my IRA might invest in 3 different LLCs, but if each LLC is in the same trade or business, let's say renting buildings, then one of them loses money, I can use that loss to offset another one. Now, where can I not use losses to offset? Well, I invest in 2 LLCs that are rentals, and then I invest in a Dairy Queen, and one of the rentals makes a loss. Can I use the rental loss to offset the Dairy Queen gain? No, those are different trade or businesses. They would have a different NAICS code, and so I can't match them together. I think that's a pretty liberal standard, and we've been aggressively on returns using that standard to get the clients as much loss as possible and reducing UBIT by as much as possible. It's unclear whether investments in partnerships, LLCs, and LPs all have to be treated separately. We're just using the NAICS rule and saying that, hey, if they have the same ID number, if they use the same code for the trade or business they're in, we're going to go ahead and use losses to offset gains between them. So that's the new tax law. Basically, it requires you to treat each business as a silo, and losses from each silo cannot offset gains from another. But at least for the present, we don't have a lot of guidance, and what guidance we do have is pretty liberal, and we're going to take advantage of that to help the taxpayers. And that concludes the discussion. Are there questions? Mary, I don't know if you had got any questions.
Yes, John. I have a question. What is the most common return filing that is missed?
Oh, definitely the pass-throughs. In other words, somebody invests their IRA into, let's say, 3 different LLCs or LPs or private placements, and they just don't file. They don't understand that if one of those entities does something, that action is attributed to the IRA, and the IRA has to file. In fact, they argue with us. It's kind of fun. They'll, well, I'm very passive. I don't do anything. Well, it doesn't matter. The Congress didn't say if you're passive or your IRA is passive, it doesn't have to pay. Well, that doesn't make any sense. Well, that's arguable, but it is what Congress clearly said. So whether or not it makes sense, you have to do it. We see a lot of that. We see people very surprised that a leveraged rental investment, even if they're a very small percentage of the ownership, can result in tax to their IRA.
And John, what's the most common error that you see on returns?
Record keeping, probably at the top of the list. I mean, we just get horrible records that make it very expensive to deal with. In terms of the substantive error, I would say joint ventures. In joint ventures where the underlying activity is a trade or business, let's say a lot of flipping, not seeing that on the return. I think we've also seen advisors who are too conservative about this trade or business rule. In other words, they treat every separate rental or every separate investment, no matter what, as a completely separate trade or business. And so there are losses that the IRA could have used to drop UBIT that these advisors are not using by being too conservative. I think the NAICS rule that I just mentioned, we have to remember that if those separate activities have the same NAICS number, it's treated as one trade or business, and therefore the losses are available for use. So I'd say that's the number one thing I've seen other preparers do.
And what if I am just a passive investor in LLCs that borrow?
Yeah, see, we get that all the time. If you're just passive, it doesn't matter. If the LLC did something, borrowed, has an ongoing trade or business, rents out personal property that causes UBIT, your IRA or 401k or HSA or whichever account has got a UBIT issue. Now, if you're not over the $1,000 threshold, then you're probably okay. In other words, you can do 1,000 of gross income and not have to report. But otherwise, even if it's completely passive, and in fact, for an IRA, it's normally completely passive by nature, you still got that liability.
And John, I heard that 401ks are exempt from UBIT. Is that true?
No, they're partially exempt. So there's this, it's a small but important exception. 401ks follow all the rules we discussed with one big exception. The exception's big because a lot of people like to invest their 401k or IRA in real estate. If the 401k borrows to acquire or improve real estate, that borrowing itself will not cause UBIT. Now, anything else the 401k does that would normally cause UBIT, borrow for non-real estate purposes, run a trade or business, will generate UBIT. So it's an important clarification. It's a great loophole, but that is what it is. It's a loophole. It's not a broad exemption. 401ks still have to worry about UBIT.
And what if I have a checkbook LLC?
Same issue. The IRS, with a traditional checkbook LLC, the IRA owns 100% of it. And so the IRA, it's ignored. I mean, under tax law, 100% owned LLC is it's a disregarded entity, a non-person. And so the UBIT still passes through to the IRA. Now, if the IRA owns a C corporation or it owns an LLC that is taxed as a C corporation, that's a different story. Then that goes back to our discussion on blockers, which if there's UBIT, you're paying the corporate rate instead of the UBIT rate, and that's normally a good thing.
So, John, what is your average cost to file a 990T for a client?
The old lawyer answer, it depends. It hovers around $600. That's where it tends to hover. It's going to depend on, obviously, how much the IRA is doing, but also to a great degree on record keeping, especially if we're getting something other than K1s. I mean, the K1, the first year, when you have an IRA that invests in partnerships or LLCs or private placements, if that's all it does and it gets K1s, the first year we have a fair amount of work to do. Subsequent years are easier, and so the price will drop in the subsequent years. Once you start doing things directly in the IRA is directly buying things, or it has a checkbook LLC that is directly buying rentals or doing flips or whatever, then it gets more complicated and a little bit more costly. In that case, your records matter a whole bunch. I suppose the other issue that matters when we're doing returns for someone's IRA that deals with an investment. Let's say a bunch of IRAs invest into a LLC that's buying rental property, borrowing on it, and eventually selling it. When we do that, if the LLC promoters are cooperative, it can make things a lot cheaper. In fact, if sometimes what we have had is an LLC promoter will come to us and say, look, we want all of our IRA investors to use you for 990Ts. Will you give us a break? Absolutely, because it's a lot less work for me. Because once I figured out the numbers for the underlying investment for one investor, it's much cheaper for me to do it for all the other investors because a lot of the work is already done. So there is a matter of scale. If investors come to me as a group on one investment, it reduces my work and therefore reduces my fees.
So, John, what can a client do to reduce your bill for filing returns?
If it's an investment that is in a syndication or an LLC or an LP, get cooperation from the sponsors. If it's an investment that they're doing themselves, QuickBooks. Run it just like you would a regular LLC in terms of a set of QuickBooks. Give me a good balance sheet. Give me a good income statement by deal or by property. That's going to make my life a lot easier. And whatever makes my life easier means I take less time. And when I take less time, you pay me less.
Well, thank you so much, John. And I will tell members of our audience, if they have any further questions regarding our discussion today, please send them to me at mmohr@ritaus.org, and we'll be sure to get those to John and get your questions answered. John, could you advance the slide? We have just a couple of more things to talk about. We have the IRA Institutes, sponsored by RITA, to be in Westlake, Ohio, June 2nd through 4th, and then we'll be in Las Vegas in September the 15th through the 17th. You can register online at ritaus.org. And I think we have one more slide, John, and that will, if you can advance that. And we have a spring conference set in Washington, D.C., the end of the month, March 30th through April 1st, and we would encourage you to sign up online for that as well. So with that, I'm going to thank John Iyer. You did a great job. Complicated subject, but I think it is a lot more simple now. So thank you, everyone, for joining us. Bye-bye.